much for tuning in. I'm here with my co-host, Matt Druin, and we're ready to announce another exciting episode with you. We've got Jeff Greenberg in the waiting room right now, about to pull on. Matt, you have any opening comments before I bring Jeff on?
Bring him on out.
All right, let's go. Hey, Jeff, how are you?
I'm doing fantastic, guys.
Awesome. So we usually start the show by just having you tell everybody, where you're at now, kind of where you came from, what your background was in, and just, a little bit of brief history over what led up to where you're at.
Okay, I started in real estate probably in about 2005, doing the single family home thing, but got really into commercial real estate in about 2007. Was doing that, buying multifamily properties, including student housing, until last couple of years. And since then, I've been pulling myself out as far as operations. So all of that time I was the main GP. I was the main guy. The buck always stopped with me. And so more recently, I started deciding that I wanted to do less. I wanted to work on the equity side. I would rather work with people that are good quality operators, and I knew how to find them. I knew how to vet them, and I would bring in equity into those deals. And so now I have my customizable equity funds. I have two different funds, and we invest in all different asset types and classes and help my investors get into quality deals.
Wow, that's really exciting. Like, I'm curious as to how you did that, how you parlayed, and did you join any masterminds? Were there books out there that really kind of helped you along the way, or was this like you met somebody that was doing it and they kind of coached you? Like, it seems like a pretty big change to jump into capital raising.
Yeah, there was a lot of things occurred when I was looking to do it, when I was deciding that this is what I would rather do. And I have been in many different masterminds. I'm still in several different masterminds. I'm in a lot of groups where we just try to figure out what's going on and try to learn as we're going. But masterminds helped out, certainly.
Mm-hmm. Did you have any mentor along the way that really sticks out as somebody that you really couldn't have gotten to that next level without?
Well, Hunter Thompson was, a big help as far as getting into the equity raising and learning about funds. So that was a big step. And then I'm also right now working with a mastermind through Investor. Investor is a platform, and we have a mastermind within that. So that's certainly helpful. And then I'm also in a group called Connected Capital, where it's a bunch of fund managers that get together and look at deals and negotiate terms with operators and help do the vetting and work in that. So all of those I would consider somewhat masterminds.
Yeah. The Capital Group, where did you find that? Was that like a LinkedIn kind of network or?
The Connected Capital is basically a bunch of us that have met throughout other masterminds. A lot of us are either are or have been in Hunter's group, which is Raise Masters. A lot of us are using the Avestor platform. So we met through that, but we wanted to do it a little bit differently. And so we essentially formed our own group that works together to do due diligence together. Doing due diligence on a sponsor or on a deal is a lot of work. We are doing the vetting for our investors as well as ourselves, because we're investing alongside of our investors. And so it is a lot of work, but if we could get 4 or 5 of us doing it and sharing the workload, it makes it a lot easier.
Yeah, I got 2 quick follow-ups and then I'll let Matt jump in. On the Avestor collective, is that a free thing? Because Avestor, they're kind of vested in getting you guys to use their software, so they're providing you some training, or is that still like you've got to pay to play? So that was the first question, and I'll go ahead and go with that one.
Well, the mastermind itself is free. You're paying to be on the platform, so all the extras that they throw in are at no extra cost.
Nice.
So and the help that they provide, which includes compliance advice, uh, uh, bringing in vendors that they've vetted to work with fund managers. That's all free.
Okay.
The main thing is you're just paying to be on the portal.
Right. And then on your collective side, are you guys using something like Slack as your communication portal, or is it more just like kind of like emails and phone calls or Zooms? Like, how are you? I'm interested, because I think a lot of people would find value in getting into some cheaper alternatives that might be this like collective approach where a bunch of people are doing kind of the same thing and they really want to mastermind with each other, but they don't want to pay some enormous mastermind fee to get into a paid group. They might want to kind of tiptoe into it. What are you guys using for your tech on that?
The technology, we're using Slack and WhatsApp, and
Mhm.
some of the guys in the background are creating a bunch of automations to make life a lot easier.
Mhm.
But at this point, it's free to get into the group. At some point, we're probably going to charge some small fee.
Mhm.
We've been toying around with 500 a year or something. I mean, real
Yeah.
small amounts just to help to pay for the technology,
Right. Right.
because the website and the applications and stuff are
Mhm.
fee based.
Yeah. Yeah, that makes total sense. And then would that be structured as like a nonprofit?
Yeah, essentially. I mean, I don't know if we're going to officially make it a nonprofit, as far as the legal sense,
Mhm.
but basically we're just looking at seeing if we could collect enough money just to pay for the expenses, not trying to make a profit out of the group,
Right.
because the main goal is to collaborate as a group for the benefit of everybody.
Mhm. Man, I love that. I'll let you
Yeah.
jump in, Matt.
All right. So my first question is, in the green room, we were talking about this manufactured housing community deal that you just closed on. By the way, congratulations. Um, Closings have gotten a lot tougher in the past year or so. So tell us about that deal and the origin of that deal. And had you done manufactured housing communities before?
It's a mobile home park, but I guess it's pretty similar to the manufactured housing. But no, actually, this was the first time I've been into a mobile home park. But the group that we've invested with is very experienced in the mobile home park, and have they their niche is distressed mobile home parks. So I
Hmm.
believe this one's about 50% occupied, and that is their striking point. But that's their expertise. So essentially we're looking for different groups that have different expertise in different areas, and that's what we want to invest with those people, those specialties. I mean, I have my expertise in mobile multifamily and student housing, but there's a lot of other areas that I don't have an expertise in.
So tell me about how this deal came across your desk, and also like what you saw in terms of the upside opportunity to it being new to that asset class.
Well, first of all, I had met the person that's running it. I'd met him several years ago. I've also met him again on another mastermind trip that we took, a retreat. So I had an opportunity to talk to him and his team because I was very interested in that. And then basically we invited him to come and present to our group to see if anybody wanted to participate in this particular deal. He had several of them. We just picked one that we decided we wanted to get into. But this has been a courting for a while. And typically, most of the deals that I'm in, I've known people for years before I really get into them. Now, with this group, I'm meeting other people that other people have known, but we get references and then bring them in for presentations, and they'll do a presentation to our group. If enough people in the group want to raise for the deal, then we form a team and start doing the due diligence.
So what did you like about this one deal in particular, and why the other ones didn't really pass mustard?
Well, this deal we liked the area. We also um, we liked the demographics of the particular market. There was one that was in Dayton, Ohio, and that market didn't excite me when we looked at the stats in there. This one's in Florence, South Carolina, which is close to Myrtle Beach. It's a much better market. We also liked the information that we got on the property as well. So a lot of time it's demographics because it's with the same operator. So the operator we already vetted and we liked him, but we decided just to pass on that other one.
Now, what was the business plan? Was this a value add type of deal, or was it sort of like a coupon clipper type of opportunity, or what?
No, this is definitely a value add. It's a value add to bring in more tenants, to upgrade some of the park-owned units, sell them off to minimize the number of park-owned mobile homes. They also are going to be bringing in some new or used mobile homes because a lot of the sites are vacant. So the whole thing is definitely a value add. They may refi in year 3, or we may sell off in year 3, depending on the economics.
Yeah, one last question on this, Mark. I have some background in it. The reason why I call it manufactured housing communities is because I went to an MHI conference, the Manufactured Housing Institute, and I got quickly and sternly corrected when I called it a mobile home park. And they're like, no, it's a manufactured housing community. So I was like, okay, I got to be PC with the industry trade people. But yeah, no, this definitely reminds me of a value add deal that I took over in Orion Lakes, Michigan. And it was a 50% occupied mobile home community. And it was crazy. We were going on like this site called MH Village and Craigslist and Facebook Marketplace and finding homes that we could pull from other communities that were in decent shape. They were vinyl sided, shingled roofs, and bringing them on site and with the hopes of selling them to the residents, as well as we partnered with 21st Mortgage, which is a company that lends on mobile home parks, and mobile homes in general to the actual end user. And we brought in like 15 homes, brand new homes to the community, kind of like a setup as like models to sell brand new homes to those. And, it's definitely an interesting strategy because it's like Legos, because if you have like 50 to 100 vacant home sites on there, those are already pre-approved sites you can pull a home into. Try doing that with, adding on to a apartment community in a town with, zoning and that sort of thing. So that's really different. It's really interesting business model.
Yeah. And also if you have the space to go and add spaces, add sites, that's an additional as well. But of course, then you've got some infrastructure to deal with. But yeah, certainly being able to bring homes on and be able to either sell them to the tenants or rent them to the tenants.
Are you ever looking at developing them and starting from, the ground and making it yourself?
I haven't. I mean, if I found a sponsor that was doing that, I would be interested in looking at that. I'm interested in getting into development, but right now I'm more looking for cash flow assets where development, you may not be getting any cash flow for 2 years or so.
Yeah.
So it just depends. I'm looking for quality sponsors doing quality deals, and we're getting all kinds of interesting things coming our direction. We just have to decide, if it's something that we want to get into and that we think our investors would be interested in it.
Yeah. As far as geography, are you open to the entire nation, or are there certain areas that you really want to focus on?
I kind of like the Smile States, where the Sun Belt areas. I stay away from California. It's too expensive. Florida makes me nervous with the insurance issues and the floods and stuff. So, kind of stay away from those. I like it closer on the West Coast because then it's easier for me to get to. Those long flights aren't a lot of fun.
Yeah.
But I'm open to it. The main thing is the sponsor really needs to convince me why I want to be in that market.
Yeah. What about your due diligence process? Speaking of flying to go, like how many times are you getting out to the site and looking at it? Is kind of like upfront, vet the sponsor, look at the project, and then you're pretty much done going there?
Yeah, pretty much. We'll either I'll go out or somebody else on the team will go out, or a lot of times we'll have somebody in the group that's close by, and they'll go and check it out just to see that it's real, that there's something there, that they're, the glossy pages aren't throwing us off,
Right.
just to make
Yeah.
sure there's really something there, because there's nothing like actually looking at something. It's amazing how good things could look on pictures.
Right. Yeah. And so you've got somebody you trust that you'd be willing to take their word after they saw it. You don't have to see every single deal yourself.
Yes, correct. I mean, somebody in our group that's going to be raising for it, or somebody that I trust in our group. Yeah.
Yeah.
Somebody outside of the sponsor group. Even though we're trusting the sponsor, we also like another set of eyes.
Yeah. And how many people are in your group?
Well, I mean, there's probably, I don't know, maybe 200 people on our list, but there's probably about 30 or 35 people that show up to our meetings.
Okay.
And on any particular deal, there may be 4 or 5 fund managers that are involved in the raise.
How would people find your meeting group?
That particular group, the website is connectedcapital.fund. And we meet every Friday for a couple hours, and typically we'll have 1 or 2 sponsors giving a presentation, and then we'll do a Q&A with the sponsor, and then we'll usually afterwards have a conversation to see how many people are interested and if we're going to go ahead with that deal. So just about every week we're seeing a new sponsor or a new deal.
Okay.
And even sponsors sometimes that don't have deals that want to meet us. And then also we have people that are doing 506Bs that can't really share the deal with us. They can come and introduce themselves. We'll get to know them and start to build a relationship so we can see their 506B opportunities.
Very cool.
Because I have both a 506B and a 506C fund.
Gotcha.
So was that intentional in terms of having those two?
Yes, it was. I had the 506C, and I had a lot of people that I've known for years, and they still want me to help them find opportunities. So I said, okay, I'll set up this 506B, and we'll go with there.
So explain to the audience the intentions behind that. I get it, but some people may not know about that, that kind of industry insider trick.
Well, a 506B is open to non-accredited investor. An accredited investor is someone that makes over $200,000 a year, or in combination with their spouse over $300,000 a year, or has over $1 million of net worth, not including their primary residence. And there's some other ways to become accredited as well, but those are the main ones. And then you have those that are sophisticated, that understand finance, business and finance, and can make decisions on their own as far as investing. Those would be considered sophisticated investors. So on the 506B, you could have 35 sophisticated investors and as many accredited investors as you want, but you're limited on that. Now, you are limited to not being able to do any kind of advertising. You are not able to present any kind of 506B deals to people unless you have a significant relationship with them. So that's why it's important to establish a relationship if you want to get into 506B deals. Now, if you're accredited, you could be in 506C deals. 506C deals, the sponsor can advertise. You don't have to have a pre-existing relationship. So it's a lot easier on the 506C, except you have to prove that you are accredited if you want to go into a 506C deal. And there's plenty of third-party agencies that will give you that will certify that you are accredited. You could go online and find them. But those are your major differences.
Mm-hmm.
So let me ask you this, when the rubber hits the road, I mean, because you're not currently raising actively for a particular deal or fund, what's your methodology when the rubber hits the road in terms of order of operations when you have to start raising?
Well, I mean, before I'm raising at all, I'm still always active in networking, going to different events, I'm active on social media. So I'm always trying to meet new people that I could help that are looking to be passive investors and don't have the time or knowledge or uh, inclination to do the amount of work that it takes to find good sponsors. So I'm always doing that. And then on the other side of it, we're always looking for good sponsors. So when I go to different events, I'm always talking to people about, what they're doing and their experience. And then also on our Friday meetings, as I said, we're always meeting new people that are being brought in by somebody else, and we're evaluating those sponsors. So essentially, those two tracks I'm always doing, looking for good sponsors and looking for potential investors.
Yeah. On the looking for potential investors thread, what are the low-hanging fruits that you find that are really worth the squeeze? Like, what would you say your top 3 are?
Well, the ones that I've used for the last 14 years is going to a lot of events. I go to different events and I meet people and I talk to them. I let them know what I'm doing. Those are the big ones. Social media is newer to me. I've started doing more social media within the last year or so, and I'm doing a lot of posting. Well, I have my social media person. She's doing a lot of posting because it drives me nuts. That's not exactly something I enjoy doing.
Mm-hmm.
And I think the jury's still out. It's interesting. You do a lot of posting, you expose yourself and let people know who you are and what you're doing. And the jury's still out as far as how much you get back. I mean, I get people back contacting me and asking me questions, but we'll see how that stream comes through. The other thing is podcasts. Getting on a lot of podcasts, getting myself out there. I do get a lot of people saying, "Hey, I'm interested in hearing about what you're doing." So it's doing a lot of different things.
I'm a big proponent of belly to belly. I think more business is done that way, and it's one of the ways that the younger generation is really shy to embrace. They want to text, they don't want to call, they want to email, they don't want to go somewhere. So I really think that that's kind of like a lost art. So I'm glad to hear. What events specifically are you trying to stay away from real estate? Because it's kind of like a crowded space where people already know it, they already do it, and you're going to what events are you going to?
Well, first, let me comment on your comment. I totally agree. I think you know somebody much better when you're sitting there pressing some flesh or sitting there having a meal with them. So that's why, a lot of times these events are great. Meetups are great. It's just you're not meeting the numbers. But I do go to something like I'm going to be going to the Best Ever Conference coming up in April. I'm going to go to Raise Fest, which is something that's going out here in Arizona. The problem with some of these, like something like Raise Fest, is great for people raising equity if you want to meet more people raising equity and you want to meet sponsors, but you're probably not going to meet much in the way of investors. Something like Best Ever, you get a combination of all different. You got some people that are investors, want to be passive investors. Others, you got others that are sponsors, you got others that are raising equity. There are others that I try to get to, some business events, wealth building events. There's an event that I'm not going to mention its name, but I like to go to because it's all doctors talking about real estate. So that one, I last time I was there, I think there was myself and one other person that was not a doctor that were, raising money. And that's the kind of events I like to go to.
Yeah, I can see why you
Especially
don't want to name that one.
especially when you go up to somebody, instead of saying, what do you do in real estate? The question was, what are you doing in medicine? Because
Right.
everybody there had something to do with medicine. They were a doctor, or a therapist, or whatever. So I want to get into more of those with different businesses. So that's what I would recommend, where not everybody in the room is sitting there trying to raise money.
Yeah. Yeah. Luckily, my wife is in the medical community, so I get to go to a lot of her events,
There you go.
by proxy. So I totally agree with what you're saying.
Absolutely.
Yeah, so a slick trick that somebody mentioned one time that was a guest on one of our shows was he would go to these conferences, like medical conferences, veterinary conferences, even stuff that like is in your own backyard. You don't even have to get in a plane and go to, especially if you're in a decent sized metropolitan area. And he'd find out where which hotel the conference was getting hosted at, and he'd just go there and hang out at the lobby bar. And he would strike up conversations after some drinks were flowing with people that were there. And when you get on the conversation of, oh, what do you do? And it's like, I'm a fund manager for real estate private equity or something like that. Oh, what's that? So no, that's definitely smart, because like, yeah, I mean, like, where's your voice of customer? And where do they live? I went to BP Con in Orlando just recently in October. I went there because we've had a lot of guests on my show that were speaking there. So I wanted to meet them face to face, because I only met them over Zoom. But there was a lot of people there that were just like newbie investors, people that were raising money. Not really a lot of people that were looking to passively invest, which is where Mark and I want to get eventually. We want to get out of out of being active sponsors at some point in time in our life. But speaking of that, is there any particular experience when you were active that is like you go back to and you're like, this is why I'm doing what I'm doing now? Like the particular like story or battle scar or battle or war story that you have in your past.
You're asking what made me change from active to passive, or to the funds, the equity side of it? Is that?
Yeah, I mean, was there a collection of experience, or even one experience that you had, you were like, enough is enough. Like I just can't do this more.
Sure. Yeah, we had a property in Amarillo, Texas, 225 units, and I brought on a lady to be the asset manager. She didn't want to be an employee, so we brought her into the GP team. So she was, one of the GPs. And I mean, I was always leaning towards the equity side. In most of the deals, I had raised most of the money anyway. But just watching her work told me that all I wanted to do was to work with people like her. All I wanted to do was to be around people that knew what they were doing with the asset management, worked with the property management, and so I've raised money for 2 of her deals since then.
Wow.
That she was the main GP on. And there's others that I've found also that are similar to that. All I want to do is find more people like that, that loved the running of the deal, the active part of it, because even though I had to do it and I wore all the hats, that wasn't my thing. I didn't really enjoy that. I would much rather work with investors and help them understand the business and help them get involved with the business. That's where I have a lot more enjoyment doing that. And so typically you're better at what you enjoy.
So you're a natural capital raiser, is what you're telling us.
I don't know how natural it is, because the first time I raised capital, I was scared shitless.
Really?
Can I say that on your podcast?
Yeah,
Excuse
yeah.
me. Otherwise you could bleep me out.
No, we're live, so yeah, we're live. But no, why don't you walk us through that? What was that first one like?
Well, the first one was we were buying a 20-unit property. We had to raise a whole $350,000. I think the purchase price was $1,080,000, something like that. And my partner and I had never raised a penny before. And it ended up we each raised half. Now, she raised the money from people that she had known pre-real estate. So like people she had worked with, friends, employers, whatever. My entire raise, every penny of it was somebody that I had met after real estate. I had met them at a meetup. I had met them at a seminar. I had met them at a boot camp somewhere. Now, we were real fortunate that this 20 units was actually 5 fourplexes owned by 2 different developers. So we were getting the squeeze that we weren't getting the money raised. It was 2 or 3 months. I don't know. We were taking a long time and we didn't have all the money. And I woke up one morning at 3 o'clock and I said, wait a minute. This is 5 different properties with 5 different deeds and 5 different loans. I said, why don't we had enough to close on 2, I think. Let's close on 2 of them and then see if the sellers will let us push the other ones out. So we closed on 2 of them, I think in, I don't know, it was August or something. And then we closed on the other 3 in December or something in order to get that thing closed. So we were fortunate that it was actually 5 different properties, but we were treating it as a 20-unit apartment.
Yeah.
But yeah, I mean, no, that was thinking about raising that kind of money was out of our wheelhouse. We were definitely pushing it.
Now, would you have been able to get away with that in this marketplace, or is it too competitive now that, you know, they wouldn't have waited that long? They've been, sorry, I got another buyer. Or do you think that's still
It
doable?
depends. These were developed. This was in 2010, and these were 3-year-old properties. They built them in 2007. They were being managed by the developers. Okay. They didn't want to be managing the properties, nor did they want to own the properties. They just couldn't sell it. So they were desperate. They wanted to sell it. Now, the bank is actually the one that got a hold of my broker and told him about it, because the banker wanted them out of the deals because they were lousy managers. They were always late on their payments. They were behind. They were 2 or 3 years behind on their taxes. The lender wanted us to take over the property. Yeah. And so they would have done just about anything for us. In fact, the lender the regulator wanted the lender to reduce the leverage and wanted us to come in with more. And we told the bank we didn't have more to come in with. We weren't going to raise more money to come in with it. So the lender went to the seller and negotiated a second for us.
Wow.
If you've never heard of that before, I sure hadn't. They negotiated a second. They made up the contracts for the second, and the seller signed a second in order that we didn't have to bring in more money. Okay. So that's how much everybody wanted us in the deal.
It was like borderline where they were going to be losing money, but they ended up getting out pretty even, you know, with the carryback.
There was 2 different developers. One of the developers was going to have to come to the table with money, and he refused to. So my broker put up the money. Okay. My broker put up the money so he wouldn't have to come because he had back taxes. The other guy didn't make much money. It was a small second. And so that's what that one was. Yeah. But they made a little bit of money on it. They didn't make much.
Yep. Well, that's good. A brand new product.
It was good for all of us.
And then you got the rents up, you got it stabilized. What do you do for property management?
Well, the problem was it was stabilized. And and this was the other lesson learned, is there wasn't a lot of value add.
Okay.
We weren't able to get the rents up very much. They were already being billed back, or they were already paying their own electric. We were trying to bill water. That was being fought, and it was already 100% occupied. So the big lesson was there was no value add, and raising the rents was a real problem. It was real slow. So it took us, we held that property for 6 years because it was very difficult to add value to it. Yeah. And we wanted to get a better return for our investors. So as we say, you know, this was a seminar for us that we learned a lot of lessons, but you know, our investors did okay. They didn't do what we had hoped to get for them, but you know, that's the way that some deals go.
Would you do that deal again?
No.
No, but
No, I
you
mean, it
need,
was as a beginner deal. Yeah,
yeah. It
it was a
wasn't too
lesson.
big that you didn't make any huge mistake. You learned a lot, and you still retained your investor relationships. I think if you don't lose your investors, you're doing good,
Yeah,
right?
yeah. The main thing is you need a deal that you could add some value to,
Yeah,
and thinking that you're going to be able to raise rents in a small market, and that's going to be your value add. You know, that just isn't a good way to do it. I mean, unless if somebody wants to buy a property and hang on to it for 30 years, that's a great investment. And I know a
right.
lot of people with that model.
Yeah,
But in 6 years, we had barely raised the value in order to cover the broker costs.
Mhm.
So we drew a line in the sand and said this is the price that we wanted, and whatever it took us to get that. We actually got an extension on the loan in order to get to that price so we could give our investors a decent return. Otherwise, the broker's fees were going to wipe out any value we added. So it was definitely a lesson. You need to have some value that value add in a property, unless you're going to be holding it for a long time and just relying on generic rent increases.
Mhm.
Because this was a 3-year-old property, there wasn't much we could do with improvements.
Mhm. Do you ever pivot kind of like midstream? Let's say you had something set up and you're planning on doing 5-year, and your gut feeling is that if you keep it for another 1 or 2 years, you're really going to boost the return. Do you ever make those kind of decisions, or if you set it at 5, you kind of stick with that?
Oh, absolutely. You have to make changes. I mean, the next property I bought after that, we were supposed to hold it for 5, and my broker came in and said, "Hey, in I think year 2.5," he said, "Let's sell it." And I gave him a price. This was a 64 unit property, but it was. I said, "Yeah, if you could sell it for 2.6 million, we'll do it." Because in 5 years, my projection was we were going to sell it for 2.1 or 2.4.
Mhm.
And I said, "Look, if you could do 2.6 right now,
Do
we'll
it.
do it." And so he got 2.7.
Wow.
So we sold it in 3 years. The investors got 120% return on their money over a 3-year period, so 40% a year.
Nice.
They did okay, yeah. And the other one I was talking about, the one in Amarillo, we sold that one in 2.5 years.
Mhm.
In 2.5 years, investors got a 70% return. So,
Very nice.
yeah. The thing is sometimes it doesn't make sense to hang on. You
Mhm.
know,
Right.
if you hang on, all it's going to do is dilute that.
Mhm.
Right.
So they're not going to get that kind of return. If they could take that money and put it into another investment, then they're way ahead of the game.
Right.
Sometimes it just doesn't make sense. Now we're in a whole different market right now,
Yeah.
and more than likely we're not going to see those kind of increases. A
Right.
5-year deal is probably going to at least be a 5-year deal. Could be a
Right.
5 to 7-year deal,
Yeah.
because we're in a whole different environment.
Yep. What's your outlook on the future?
Short term or long term?
Oh, both. Walk us through what you think is going to happen.
Short term, I'm cautiously optimistic. I think there's going to be a lot of distress out there. I think a lot of banks. I understand a lot of banks are renegotiating some of the terms that a lot of people aren't paying their payments right now, and the banks don't want to foreclose on them. So there can be some great opportunities. Um, I'm I love the rumors that interest rates are going to go down. I'd like to see that. Hopefully, I'm just real cautious right now. I like fixed rate loans right now. I've gotten into a couple deals that we've got into assumptions. Nice, 3.8% or so loan assumptions. Those are nice.
Yeah.
Bridge loans, people have gotten in trouble because of bridge loans. I've used bridge loans, but the increase in interest rates have really killed a lot of people.
Do
The
you
other
think
thing
the
that concerns me is insurance rates right now.
yeah.
Insurance and taxes in a lot of areas are gone a little crazy.
let's say that the Fed does make a couple cuts this year. Do you think that's enough to start to make some stuff that's purchased now be resellable, or is it one point's really not going to do much?
It depends. It depends. I have the last property that I have that I'm active on. Um, I'd like to put it on the market, and if the Fed starts showing that they're going to be lowering the interest rates, and that may start getting some interest.
Right.
You know,
What does that look like? What does that translate to for profitability? Let's say they cut it 1%. What are you thinking that's going to do to your return?
oh, I'd have to sit down and calculate
Yeah,
that.
calculate
As
it.
far as I don't have that in my head, but I would. The main thing is an investor able to get a decent loan. The particular deal I have is in a small market, so it's going to be, and it's student housing, so it's nichey anyway. So those are harder to get loans anyhow, and they're probably going to have to go to a private bank or something. So it all depends.
On the
Yeah,
product.
but at least
Yeah.
I think the idea of at least the interest rates going down, the idea of interest rates being lowered is important. Not just the number. It's just that, okay, we're in a position now that they feel comfortable lowering the rates. And so now people may feel more comfortable about the market. People are scared. See a lot of things on the news,
Yeah.
And they're going to be more cautious, and I think that's important I think that's important to be more cautious, but not to be scared to death that not to invest. There's still a lot of good deals out there. You just have to kind of know what you're looking for.
Yeah. Speaking of the news, there's been so many headlines recently, at least that I've noticed on, all my YouTube feeds of the different channels that I watch. Everything seems so negative. I don't know if you guys have noticed that, but just over the last 2 weeks, it's like everybody is, the sky is falling, it seems like.
Well, negative sells.
Yeah, that's true.
I mean, we
It's
know
it
that.
just it seems like it's more prolific right now than I've noticed but maybe I'm just being more sensitive to it.
Well, I mean, I think we notice that a lot. And somebody says something good, you don't notice it as much as if somebody says something bad. So that's true. I mean, there was just a conference that I was talking to somebody down in San Diego, in California here, that was a big multifamily conference. And I think the slogan of the day was "Hang on to 25." That it's more of caution right now. But if you could get into some of these opportunities, if you've got somebody that's really in trouble, there's some opportunities. That you can. I heard somebody was buying something $120,000 a door in Dallas or something, and that's pretty sweet compared to what they were going for, previously.
Right.
So there are deals out there.
Yeah. Here are the few of the headlines. I jotted them down earlier today just because I thought I'm going through my feed. I'm like, this is insane. U.S. banks in trouble again. Stocks nosedive. Banking sector on the brink. Massive risk of more bank failures. Millennial housing crisis. U.S. banks about to collapse. Inflation will return. And that was like my whole feed. There was nothing positive in it.
Wow, the stock market's doing well, so I don't know.
Yeah.
I mean, I hardly have anything in the stock market, but it's doing very well. And I've been using First Republic Bank that was taken over by Chase, and everything's going fine. So some of this negative stuff, I don't know if they're trying for clicks, or since they're not selling newspapers anymore.
Right. Well, these are all independent channels, so I don't go to any like CNN, Fox News, none of that stuff. These are all like independents.
Yeah, but I don't know. I mean, I'm very cautiously optimistic, and because I'm looking at all different asset types, I'm looking at different assets that are more resilient. If we do have a recession, we are in an election year, which, who knows what could happen. People do crazy things in election years. So So, that's why I'm not raising right now. I haven't found something I feel comfortable with. I'll get into a deal when I feel comfortable. Otherwise, I don't have to do deals.
Mhm.
I don't have anything pressuring me to raise for any deals. I get into them when I feel it's appropriate to bring to my investors.
Do you have investors that have an appetite right now and you just can't satisfy it?
I have some that are interested. I have a lot of them that are holding back. I mean, we had a fair response for this mobile home park deal. It wasn't overwhelming as far as everybody getting into it. I think it's a great deal, but some people are holding back. A lot of times you don't know from your investors. You just don't hear from them. They don't respond back to your emails and stuff. So you don't know what's holding them back, but you just don't hear from them. But I've got investors that have been with me for 10, 14 years. There was one guy's been on almost every deal I've done since I think it was in my second deal. I don't think it was in my first.
Mm-hmm.
But
what do you do for a minimum investment?
Typically $50K.
Okay.
Typically, but if it depends, if somebody's been in my deals before, and they don't have enough, cash on hand, we may go lower. If it's a new investor that I'm just meeting,
might go a little lower.
We have the flexibility.
Mm-hmm.
We can do different amounts.
Yeah, that's nice.
But typically we try to go with $50K.
So your background in student housing, what makes student housing an attractive asset class to you, or is like driven your specialization in that?
Well, it was kind of an accident why I got into it. I had an intern and he brought me a property and told me, hey, this is the property, Miami University in Ohio. Mm-hmm. And I said, what? I said, Miami University in Ohio? I thought Miami's in Florida. I said, no, Miami University of Ohio. Oh, okay. So getting into student housing was kind of a fluke, that there was a good opportunity that somebody had fallen through several times and they kept lowering their price and I got into it. Mm-hmm. So it wasn't planned. I do like student housing because of the higher revenue that you do get out of it. It's a specialty. You do need special property management. You don't want to go into property management that just will do student housing. You want it to be their specialty, mm-hmm. because it's very specialized. It's getting involved on campus. It's, the marketing is totally different. But I like it. I enjoy it. I enjoy going to the campuses and going to the property and actually meeting young people. And, but you are getting a lot more money for it. Your expenses are typically a little bit higher. Mm-hmm. But I think it's a great asset class.
Yeah, you're right. I mean, definitely the marketing is a lot different, even in the kind of like post social media age. I mean, there was a student housing project that I had to reposition for the company I was working for, and the previous management team. It was like one of those things, like you were saying, like just they're like, okay, we'll do student housing, but they had no idea what they were doing from mm-hmm. a lease up, because you got to do lease up every single year. For the most part, unless you have upperclassmen that stay for a couple of years. So, we would send our leasing agents out onto campus, like with invitations to like a party that we'd have with pizza and soda. And we bring we'd bring in like a band and that sort of thing. And we had a pretty, mm-hmm. decent sized leasing office. And that's how we did, just doing that stuff, like guerrilla marketing is kind of how we did those lease ups every year. But it's definitely a full contact type of sport for sure.
Yeah, I mean, we brought a taco truck to the school events, where you had a taco truck with a table out in front, and while they're eating, you're having conversations with them. Mm-hmm. Yeah, it's definitely specialized. And if you don't know how to do it or don't have the staffing, to do it, and most management companies don't.
Don't.
So
Yeah.
it's definitely a specialized thing. And the other thing is a lot of people are afraid of student housing, which is good.
Right.
You know, I mean, it eliminates a lot of the competition. They're afraid of it because they've watched Animal House. You know, anybody that's seen Animal House, you know, thinks, you know, God, no way am I going to do student housing. And
You do make a nice margin though, because you're pretty much charging per student. Now, what is your average unit size for a student housing unit?
Well, most of the stuff that I've had have been 4-bedroom. Sometimes they're 4-bedroom, 2-bath. It's even better. I've had some with 4-bedroom, 4-baths. That's more desirable. Even doing 2-bedroom is probably more desirable. Where it just seems nowadays students aren't as accommodating, and so the fewer people they could have fights with, you know, or disagreements with, the better, because you know you've got people. One's a slob and one's not. One likes to party and one wants to study. You know, the fewer people that are in a unit, the less chance that you're going to have conflicts. In some of them, we had some where the management company actually did roommate matching. You know, they would interview all the students and then try to match them up with people they were more compatible with, which is something you're not going to get a regular management company doing.
No, I mean, in our neck of the woods, I try to do like dot my I's, cross my T's. It comes down to zoning. And so a lot of student housing rentals are actually in violation of zoning law in that they're going to collect 4 different people. And a lot of times they won't even be on the same lease. They'll have 4 separate leases on like call it a single family dwelling unit, which is not permitted. So I try not to do that, but I do understand. Well, I don't try, I don't do that. But a lot of my competitors do that. So what we do is we bring the people together and we get them to come together on their own and sign a lease, one term lease. I was going to say, have you ever looked into doing master leases with universities versus having to have that intensive management to get the students and then just kind of let it make it their problem? Like, I'm just going to master lease this thing over to the university.
That is so funny that you're asking that, because I was just on the phone this morning. We're talking about last year, the school that my Georgia property is in, they master leased half the property. It's the property is 144 beds. They master leased half of it. They would have master leased the other half, except we had already had leases signed for the other half. We're in the middle of negotiating a master lease for the entire property for next school year. And then we're going to look at doing that for multi-year after that. They are looking at possibly doing some new dorms, but that could be several years down the road.
Right.
And so we're looking at getting the master lease on this, and then we're looking at selling, because we've had this property. I think we're going on 8 years on this particular property. It's been a long property.
Sell right to the university?
That's one of the things we're trying to get them to do, is at least if they could buy it, even if they want to build their own dorms, they could buy this, hold it until their dorms are built, and then sell it if they wanted to. Yeah, we're working on that one.
Now,
right now, we want to get this. We want to get this master lease signed,
and
then we're going to start with the next step on maybe getting them to buy it.
Would you enlist a broker to do that, or would you try to do that in house since you already have the relationship with the university? Or do you think it's better just to?
I don't need a broker for that.
No, you can handle it. Okay, that's kind of what I thought.
I mean, we would negotiate it and just get a lawyer to write up the contract. I mean, that's. I've sold things by myself before. If a broker, the only use I have for a broker, I mean, if they could bring me clients, if I find the client, I don't need a broker to do the rest.
Yeah. I was just curious if the university would want to have some third party involved just to make sure that, you know, the value, because they don't specialize in real estate, obviously. But no,
they probably have their lawyers involved. I don't know. And they may, who knows,
make it subject to an appraisal or something.
Yeah, there'd be an appraisal or whatever they had to do, and maybe they'd bring in their inspectors or something. I'm sure, you know. But the thing is they actually used to own this property before. So they owned it. God, I don't know, maybe about. Well, they owned it when it was new. It was built in 1999, So they actually owned it, and then they built their dorms. So they know the property pretty well.
Yeah. Now, are you giving them a discount on that master lease? I would assume so. As far as,
Not really. The main reason is that we were having some, there was some new properties that came online. And so we ended up dropping our prices to compete with this new property that came online. And so now we're in the process of bringing it back up. So it actually is a discount. They are getting a discount from what we would be charging other people. So yeah,
little
but
discount.
we're bringing the prices up. We just brought the prices up from what they had for this year, and what we're doing next year. We did raise the prices about $50 a bed.
And you've essentially eliminated, a significant percentage of operational expenses by master leasing it.
We have we'll be able to eliminate our marketing. We'll eliminate our delinquencies. We'll eliminate having to do evictions. We'll take off the table for our on-site management, all the lease up stuff, which means that she could focus more on maintenance type of thing. And also we're doing special events. She's doing a lot of event stuff. So that's going to help free her time up for more of that stuff. So yeah, it does change the operation some. That's and nice. We don't have to worry about collections. That's nice.
Yeah. So you're looking for more master lease opportunities?
Not particular. We're gonna, as soon as we're ready to sell this deal. Once we sell that, then I'll go and just do my funds and not do any active operations.
Yeah,
I've had my fun with that. There's plenty of other people that are anxious to do the active operations, and let them go for it.
So, Mark, we got a few minutes left here. How you want to wrap up?
I don't know if you had any more follow-ups. You can go ahead, Matt. I feel like I've been like monopolizing a little bit. I feel
yeah. Well, no, I mean, Mark. Yeah. Mark and I are in a student housing town, but it's a lot of scattered site student housing with like the small single through 4 family housing stock that we have. But we have 7 universities around Rochester?
Yeah,
just about. Yeah. So yeah, there's a lot of it, and none of the schools have enough capacity in their on-campus housing. So there's definitely a lot of demand there, but not products to meet that. So there's definitely a contention between, there's like one neighborhood that's bordering University of Rochester. It's called the Plex neighborhood. And slowly there's been, people buying houses there, turning it into student housing. And they've been, kicking out the people that have lived there for decades, for instance. But, the University of Rochester is like, we have no place for these students to go. So, so it's definitely interesting to see in terms of that, like in our local economy. But yeah, I think Mark is definitely has a lot of exposure around the University of Rochester area. So
yeah, and you could probably pay a lot more than a homeowner that wants to come in and buy the house, and so you're probably pricing them out, I would think, because
it depends on the specific market. The closer you get to the university, the rents aren't going to keep up. The homeowners will come in and they'll spend, $400,000, $500,000 on the house. And from a rental perspective, that's just not going to work.
Yeah.
But if you get into a less desirable neighborhood, you can pick up a house for $60,000 and rent it out for, $1,500. And it really does work. So it just depends on the specific neighborhood.
Yeah. I guess it also depends on the zoning. I mean, all the places I've been, we've been properly zoned. There was one we had in Tucson where it depended on how the property was described. If it was a group home, they had one, the parking requirements were different than if it was, I forgot what the other category was, but one of them, you had to have one parking spot per bedroom.
Okay.
And the other one was you had to have 1.5 parking spots per unit. And these were 5-bedroom units. And we certainly didn't, we had to go and fight with zoning to make sure that we got it classified properly. Otherwise, they were going to demand we had more parking spaces.
Right.
So it depends. And then also in Tucson, there was a lot of people that were converting their houses, the ones that were close to the university.
Yeah.
And in order to stop that, they required a certain number of parking spaces per bedroom. And so, because you go to these houses, the whole backyard became an apartment.
Right.
It was a single family home, but their entire backyard was an apartment, a 2-story apartment, but now they were requiring that you had to include parking. That was kind of slowing that down. But yeah, there's a big demand.
Yeah. My sister and brother-in-law lived in Tucson during probably the best possible time to buy there. I did convince them to buy a property. And they're really thankful they did. I think they paid like $40,000, very close to the university. And it's probably worth 400 or something today. It's crazy what that town
I'm
is
sure
now.
if it's close to the university.
So in wrapping up here, how can our viewers get in touch with you?
Well, you could reach me at my website, which is synergetic.ig.com, and you can see the spelling for Synergetic. You could get a hold of me at jeff@synergetic.ig.com. And the other, I have a freebie for your investors, which is questions to ask sponsors when you want to get into deals as a passive investor. And you can get that at sigcre.com/sponsor. And I have a free ebook for anybody that's interested in seeing the questions that should be asked when you're getting into a passive investment. It's very important to ask questions, to increase or decrease the risk of getting into a passive investment. Ask a lot of questions.
And then, of course, the quick tip of the day was connectedcapital.fund, right?
Connectedcapital.fund.
Yeah, that's still a free group, guys. So
that's a free group for fund managers, people that want to raise money for these other deals.
Yeah. Awesome. Well, thank you so much for coming on. We really appreciate all the insights.
Well, I thank you guys. This was a lot of fun.
Yeah.
All right.
We'll wrap it up now, but we'll meet you in the green room.
All right.
All right. Thanks, everybody.
Okay.